Hello everyone, John Devine here. This is part one for the Introduction to Futures Markets video series. And today we're going to cover many things, but first we're going to start with a disclaimer to remind everyone that whatever is discussed in this video and all content on MarketMentor.io is for educational purposes only. I am not in any way providing financial advice or soliciting financial products in this video or on any content from MarketMentor.io. Trading futures markets carries significant risk and can result in loss of capital. That being said, there are some interesting things to explore from an educational standpoint in futures markets, and understanding the fundamentals can be a great advantage for those seeking to find different ways to engage in financial markets, either from a career standpoint or from a personal standpoint. So we're going to start with gold today. And if you take a look in the book, we have contract specifications for gold futures markets. And the futures market we are analyzing here is the Chicago Mercantile Exchange. So the contract symbol or the product code for gold is GC, and each contract is 100 troy ounces of gold. It's quoted in US dollars and cents per troy ounce, and the market is open for trading between Sunday evening and Friday evening, 6 p.m. to 5 p.m. There's an hour pause at 5 p.m. Eastern. The minimum tick value for gold on the CME is $10, so each tick that the market moves is either plus or minus $10 per contract based on your position. And the contract lists for 3 consecutive months, any Feb, April, August, or October in the nearest 23 months, and any June and December in the nearest 72 months. So you can trade pretty far out down the curve in gold at the CME. Now, some important dates to know as a futures market trader is the first notice date and the termination of trading date. So the first notice date is going to be the last business day of the prior month to the contract month. Since today is July 30th, 2020, we have an August gold futures contract, that is going to be experiencing its first notice date tomorrow, which is the last business day of July 2020. It's the 31st of the month. And the termination of trading for the contract will be on August 27th, 2020, which is three business days prior to the end of the contract month. So with that in mind, let's take a quick peek at the CME website. And this is a settlements tab on the CME where we can look at all of the actively traded contracts, and we can see an open price, high price, low, last traded price, and the net change from the prior settlement. This settlement is the price for Thursday, July 30th, 2020. And over here we see estimated volume and prior day open interest. Open interest is interesting here as, relatively speaking to December, August is very light, and that is due to the first notice date of the contract. Most traders do not want to have exposure to a contract once it goes to first notice, and that is why you're seeing volume go to December. Now, there are many reasons one can come up with as to why volume goes into December. December is a very important futures market month. It marks the end of the year. Real producers and consumers of gold who are using these contracts from a treasury management perspective to hedge risk, like the December contract, it allows them to hedge risk for the calendar year. And September and October for gold are just not as actively traded as August and December might be. So that kind of gives you an overview of what you're looking at on a settlements page for any futures market, really, and in this case, gold. And another interesting thing as a trader to study is, of course, contract specifications, which we detail in the book. Volume is also something to keep an eye on, although you can get a nice look at it from the settlements page. But importantly is the calendar. And the calendar is what can outline the first notice date and termination of trading date. It also shows you the day that the contract began trading. So we look at the August 2020 contract. It first started trading back in September 2018, and the contract is going to be going off the board on August 27th, 2020. If you look to the right here, we see first position, last position, first notice, last notice, first delivery, last delivery. What we are particularly interested in is first notice date, and that's going to be the 31st of July 2020, and the last notice date, which here is going to be the 28th of August. So we can take a peek at a calendar and notice that the 31st of July is the last business day of the month prior to the contract month, and we can scroll to August and notice that the 28th is the third business day prior to the end of the month. This is actually, it should be the 27th, and this is actually kind of interesting. I would be curious to look into more detail as to why they have it listed as the 28th, because if we take a look at our contract specification sheet, which is what I would be leaning against as a trader, we can see the termination of trading happens at 12:30 p.m. on the third last business day of the contract month. If we look at August, we see 31st, 1, 28th, 2, 27th is 3, although they might be including Sunday the 30th. It'd be something to look into. But that is kind of an overview of the gold contract specifications. And let's now take a look at a market. So I'm going to pull up Trading Technologies platform. I'm using a simulation here. This is not a live market. And I'm going to go into my widgets tab. I'm going to come down to a MD Trader window. I'm going to type in GC for the gold contract code. I'm going to click on, and just to very briefly look at what we're seeing here. These are the futures contracts. These are the listed calendar spreads. We're looking for the futures contracts. So I can come down. They have it nicely laid out here. GC August 20, GC Sep 20, GC Oct 20, GC DECE. And remember, the alphabetical symbol for these is August is Q, September is U, October is V, and December is Z. With December being the most actively traded contract currently, I am going to pull up the December market and take a look at the order book. So here we notice bids and offers. Bids are on the left here at lower prices than offers. Bids are contracts that are trying to buy. Offers are contracts that are trying to sell. We see 11 contracts bid for 1974 with 5 contracts offered at now 1974.2. We just saw a trade up here, but we saw a buy, now we see a sell, now we see back and forth here with a mid-market price of 1974.10 to cover the minimum tick, as we saw, is $10 from the contract spec sheet if a trader were to buy a contract at 1974 and sell it at 1974.1, they would have a profit of $10 less commission. And on the other side, if a trader were to sell one contract at 1974.3 and buy that back at 1974.2, that trader would experience a profit of $10 per contract less commission. So this is the fundamentals of an order book. We have bids, we have offers, we have a mid-market. We're looking at the liquidity here. It's hard to say if a market is highly or lightly liquid without some relative market to compare it against. So we can open up the gold October 2020 contract to take a look. But we can see that there are bids and offers 10 levels deep up and down the order book, which is a liquid market. So let's open up another MD Trader window and look at GC October 2020. So we can see the order book in GC October 2020 is less liquid than the order book for GC DEES 20. So let's pull up something from the book that talks about liquidity. So when you're analyzing a market's liquidity, here we notice in a lightly liquid, highly volatile market, there are very few bids and offers relative to a highly liquid market, and the depth of book is not as deep. We see two levels on the offer and 2 levels on the bid, whereas in a highly liquid, lightly volatile market, we see a deeper order book relative to a lightly liquid market. So if we go back to our live markets, these are live even though it's a simulation. This is live pricing. We can see here in real time that DEES is in fact more liquid than October, and I would assume that if we pull up the August contract as well, given the look at the open interest, we would think that August would be lightly liquid also relative to DEES, which it is. So we can see, and now one thing you can notice here, comparing October and August, is the depth of book and also the spread. So we see, yes, we see 2 levels, maybe 3 bid and offered in GC August, but the spread is a bit wider. So we have 1, 2, 3 ticks. Now it's tightening a bit, but it is tightening up now. But for the moment there, we saw the spread was a bit wider than the spread in October. And as a market becomes less and less liquid, the spreads typically tend to widen out. And we look at DEES, we see a mid-market, just 1 tick, and there has been some orders filling in, as we see there. So the spread is much tighter in a highly liquid market relative to a lightly liquid market. So I'm going to close out August and close out October and refocus on December here. Let's take a look back in the book at page 9, I believe it is. We're going to talk about lifting and hitting bids and the difference between being a market taker and a market maker. So on the left, we see a diagram that is showing lifting offers, and on the right, we see a diagram that is showing hitting bids. And what this means is when a trader lifts offers, they aggressively buy the best offer in the market, as opposed to resting a bid at the best bid in anticipation that a seller may become aggressive and sell to the best bid. So lifting offers is being a market taker, as you are taking from the best offer, as opposed to being a market maker who is a trader that rests bids at the best bid in anticipation for a market taker to become aggressive. Hitting bids would be the inverse of that. If you are a market taker hitting bids, you are a seller becoming aggressive and selling into the best resting bid. If you are a market maker on the offer, you are resting a quantity of contracts at the best offer or at a worse price relative to the best offer in anticipation for a buyer to become aggressive and lift your offer in the market. We're going to demonstrate that a bit here on a live market. So these orders are for educational purposes only. It's a simulation account. I'm not actually trading, but we can see here if I buy this market, I have just lifted the offer at 1974.5. And to go into a little bit more detail on the transaction, I can pull up a fill window, and my fill window shows me here sim account, John Devine, TT. What did I do? I bought, buy or sell, I bought one contract in CME GC Ds 20 futures markets at a price of 1974.5. And that is an example of being a market taker, lifting an offer. Now I will show you an example of being a market maker here. I'm going to place a one lot resting offer at 1974.5 and someone just bought it from me in a theoretical scenario. If we take a look at the fill window, you see here that I sold one GC Ds 20 futures contract at 1974.5. If we come now down to the position, you can see that my P&L is flat. I bought and sold at the same price. And if we look at the audit trail, it also confirms that I bought one contract and sold one contract here. And that's how I can make sure that the system is seeing the trades that I've done properly, and I can check myself through an audit trail, fill window, and position window. And if I want to have a position, I'm going to put a buy order in there as a resting. I'm being a market maker here. Technically, this is a resting bid order, looking for someone to hit my bid. And let's see if someone, okay, so someone hits the bid here. Now let's take a look at the P&L on the contract. So I bought one at 1974.5. The market is moving in my favor. It's now being marked at 1974.7, which is 2 ticks. Now it's going lower. You saw it went from plus 20 to now flat. So the market is back to the price that I bought it at. But the plus 20 came from 2 ticks in my favor from 1974.5 to 1974.7. And I'm going to place a resting offer here. Let's see if a bid does come in quickly to demonstrate taking some profit in the market. And if this stacks, I'm going to add to the offer at 1974.5 to scratch. And that would be getting flat my position. Offers are gone from 1974.5, and we are going to cancel that order and now put it here. And for the sake of education, I might even drag this down and just get out of the market to show what negative P&L can do. It's the same, it's the inverse of a positive P&L. So now I'm a resting order at 1974.2. Market continues to go against me. Let's see if someone lifts at 1974.2, which would be a loss of $30, as this is 1, 2, 3 ticks from my entry, and we see the P&L is minus 30. So that is the completion of part one to the introduction to futures markets, and we will move on to part two now, which covers calendar spreads.